Chapter 1. Understanding the multifaceted nature of financial risk is paramount to building a secure financial future. Risk in the financial context represents the potential for loss or the variability of returns on an investment. It's not simply about the possibility of losing money. It encompasses the uncertainty surrounding the outcome of any financial decision. A thorough grasp of different risk types is crucial for making informed choices and mitigating potential downsides. One of the most prevalent risks is market risk, also known as systematic risk. This risk stems from broad market fluctuations, impacting all investments to varying degrees. A stock market crash, for instance, will negatively affect most stocks, regardless of the individual company's performance. This inherent uncertainty is a fundamental aspect of investing, and no amount of due diligence can entirely eliminate it. However, understanding market cycles and employing diversification strategies can help mitigate its impact. For example, historically, the stock market has demonstrated a long-term upward trend, yet it experiences periodic corrections and bear markets. An investor aware of this inherent volatility is better equipped to navigate these downturns and avoid impulsive decisions driven by fear or panic. Closely related to market risk is interest rate risk. This type of risk primarily affects fixed income investments such as bonds. Interest rates and bond prices have an inverse relationship. When interest rates rise, the value of existing bonds with lower coupon rates decreases, and vice versa. This risk is particularly significant for long-term bondholders, as they are more exposed to interest rate fluctuations. For instance, if an investor holds a 10-year bond with a fixed interest rate of 4%, and interest rates subsequently rise to 6%, the value of their bond will decline as new bonds offer a higher yield. Consequently, understanding interest rate trends and the duration of your bond portfolio is crucial for managing this risk. Another significant risk factor is inflation risk, also known as purchasing power risk. Inflation erodes the value of money over time, reducing the real return on investments. If the rate of inflation exceeds the return on your investment, you effectively lose purchasing power. For example, if your savings account earns 2% interest annually, but inflation is running at 3%, your real return is -1%. Meaning your money buys less than it did the previous year. This risk is particularly relevant for long-term investments and retirement planning, as inflation can significantly impact the purchasing power.
Sample complete. Ready to continue?